national income can be measured through three methods: as value added method, which is otherwise known as product method or net output method, then income method and expenditure method. And yesterday we have already done certain numericals related to value added method. But once more I am reminding what steps are to be taken while measuring national income by value added method. The first step is identification and classification of the productive sectors in an economy. Which are the productive sectors of an economy? Primary, secondary and tertiary sectors. Primary, agriculture and related activities, secondary, industries and tertiary, services. So, primary and secondary are producing goods and tertiary sector is producing services. And the second step is, so we are identifying and classifying the productive enterprises. Then, the estimation of net value added by each producing units. The estimation of net value added at factor cost or net value added at market price by all the producing units. So, it is net value added at factor cost. For every unit we have to calculate net value added at factor cost. After that we will sum up the value of the net value added at factor cost of all the producing enterprises in order to arrive at domestic income, NDP at factor cost. So, the second step is, after identifying and classifying the productive sectors of an economy, that is primary, secondary, tertiary. We are classifying them. After that, the second step is net value added at factor cost is to be calculated for every sector. So, how will we calculate net value added at factor cost? So, as I have explained earlier, net does not include depreciation. Net concept, we get net concept after deducting depreciation from gross concept. Okay, gross minus depreciation is equal to net. What is depreciation? It is the maintenance cost. So, every asset like machine, after the continuous use for several days, several years, it faces normal wear and tear. And a cost, replacement cost is there by every firm for replacing the asset or repairing the, maintaining the asset. So, that is depreciation cost. It is to be deducted from gross in order to arrive at net concept. So, net value added at factor cost. Factor cost does not include market price. So, from gross we have to deduct depreciation to arrive at net concept. In order to arrive at factor cost, we have to deduct net indirect taxes from the market price. Kindly refer my previous module, previous video. It is clearly explained how we can calculate net indirect taxes. What is net indirect taxes? What is meant by market price? Okay, so second step is net value added at factor cost for every sector is to be calculated, and at last we are taking the sum of net value added at factor cost for every sector, and we reach at domestic income, net domestic product at factor cost. Okay, it is otherwise called domestic income. Then to that we have to add NFIA, net factor income from abroad, to arrive at national income. So, actually the first step is, in order to arrive at net value added at factor cost, we are calculating GDP at market price or gross value added at market price of primary sector, secondary sector, tertiary sector. What is GDP at market price or gross value added at market price? It is the total money value of the final goods and services produced in an economy in an accounting year. Okay, and that is national income. Total money value of all the final goods and services produced in a country in an accounting year is the national income. And there are many aggregates of national income. Which are the aggregates? GDP at market price, GDP at factor cost, NDP at market price, NDP at factor cost. That is the aggregates of domestic income, and GNP and NNP are the aggregates of national income. So first we are calculating an aggregate of national income, that is gross domestic product at market price or gross value added. What is value added? How can we calculate it? It is value of output, value of the goods produced minus intermediate consumption. What is intermediate consumption? As I have mentioned earlier, many raw materials are used. A raw material is used to produce a particular good. The value of that final product includes the value of the intermediate product. So in order to arrive at net concept, in order to arrive at this domestic income, we are not including the value of intermediate product. So first method is value of the output produced minus intermediate consumption. This we are doing for every sector, every units produced. So value of output minus intermediate consumption, we will get value added. For example, from a bakery you are purchasing maybe bread. What all ingredients, what all intermediate products are there in a bread? Flour is there, sugar may be there. It is going through different stages of production. Every stage a value is added. Farmer selling the grain to the mill. At that time the farmer is getting 1000 rupees. From the mill it is coming as flour for 1500 rupees. The baker purchases it for 2000 rupees. Selling the, after making bread, selling it for 2500 rupees. What is the value here? So for a simple example, a farmer is selling the grain to the miller for 10 rupees. The miller, he is changing it to flour and sells it to the baker for 15 rupees. The farmer is giving the raw material, wheat, to the miller for 10 rupees. This miller is selling it to the baker as flour for 15 rupees. The baker is making the bread with it and selling it for 20 rupees. What is the value of the final product? 20. Because it includes this 10 and 15. Okay. So, in this 20 rupees, this 10 rupees and 50, the value of the intermediate products are included. If we are calculating the value of the final products as 10 plus 15 plus 20, we are getting an exaggerated value. So this double counting is to be avoided. Okay. So while calculating national income, we are taking only the value of the final product. So value of output minus intermediate consumption is equal to value added. So GDP at market price or gross value added at market price, it is equal to value of output minus intermediate consumption. We get GDP at market price. Gross includes depreciation, that is a replacement cost. Market price includes net indirect taxes, indirect tax minus subsidy. Tax is an income to government, subsidy is a payment from the government to the public. So it is domestic income concept within the economy. We have to change it to national income, convert it into national income. So value of output minus intermediate consumption, we are getting GDP at market price or gross value added at market price. Then we have to arrive at net value added at factor cost. So GDP at market price is equal to value of output minus intermediate consumption. So minus depreciation. By doing the first step, value of output minus intermediate consumption, we are getting GDP at market price. Minus depreciation, we will get NDP at market price. NDP at market price minus net indirect taxes we will get NDP at factor cost or the standard unit of domestic income. To that, we have to add net factor income from abroad in order to arrive at national income. So, net value added at market price, net value added at factor cost. This value added that happens within the economy. Domestic income concepts, that is GDP at market price, NDP at market price, GDP at factor cost, NDP at factor cost. All these are domestic income aggregates. When we add net factor income from abroad to the domestic concept, then only it will become national income. What is net factor income from abroad? It is the difference between factor income from abroad and factor income to abroad. From abroad is to be added. To abroad means it is outflow of income from the country to other countries. So, the first step, identifying and classifying the productive enterprises. Second step is estimation of net value added at factor cost. How can we arrive at? We have to deduct from gross the depreciation value. We have to deduct net indirect taxes from the GDP at the market price. The GDP at market price minus depreciation minus net indirect tax, we will get NDP at factor cost. Okay. So, domestic income is equal to NDP at factor cost. National income is equal to NNP at factor cost. If simply NNP, GNP, GDP given, take it as market price. Okay. So, domestic income NDP at factor cost, national income NNP at factor cost. So, net concept does not include depreciation. So, in order to make it gross, we have to add depreciation. Domestic concept does not include net factor income from abroad. National concept includes net factor income from abroad. Then, both these are at factor cost, does not include net indirect tax. So, in order to make factor cost to market price, we have to add net indirect taxes. Okay. So, domestic income NDP at factor cost plus NFIA national income, net concept plus depreciation, we get gross concept, factor cost plus net indirect tax, we get market price. So, in order to make gross concept, you have to add depreciation to net. So, gross is equal to net plus depreciation. Therefore, net is equal to gross minus depreciation. So, factor cost plus net indirect tax is equal to market price. Market price minus net indirect tax is equal to factor cost. Domestic income plus NFIA is equal to national income. National income minus NFIA is equal to domestic income. This is to be kept in mind while calculating national income. Now we will continue with the value added method numericals.